Hello everyone, today we're finally going to talk about market maker model. But before we start, please subscribe to this channel to don't miss my new videos that I'm going to post in the nearest future. It's going to be new strategy lessons, it's going to be my trade recaps. And for this market maker model, I just want to let you know I didn't invent anything new here. Everything is available on ICT YouTube channel, but here's my personal approach. It might be a little bit different from ICT teachings or any other mentors that you know that teach market maker model. In this video, I'm going to talk about and I'm going to explain my personal approach, how I trade market maker model. All right, let's start. Okay, what is market maker model? Market maker model in general is a market structure that consists of specific sell program, sell side of the curve, and buy program, buy side of the curve. When we are on the side of the sell side of the curve or sell program of market maker model, we can safely short turtle soup as first stage within the structure of the market maker model with high probability. What do I mean by this? I mean that first stage of accumulation or distribution is always should offer turtle soup trade idea. I'm going to talk about first stage a little bit later today, but here is just for your quick note. And opposite for buy side of the curve, you want to trade first stage, once again, accumulation or first stage of distribution as turtle soup entry. I'm going to talk about this a little bit later today. But market maker model is symmetrical, generally giving you not only target, but also a time that target must be hit. Normally, liquidity levels, liquidity sweeps happen just on normal trading days, not like holiday, not any like low volatility days and any other such days, this kind of days. Okay, on normal days, and market structure just happen every day with price movement. There are only few key parts of market maker models that you must know and must understand. Original consolidation, stair-step pattern. What do I mean by this? I mean by first stage of accumulation, first stage of distribution, second stage of reaccumulation, second stage of redistribution, high time frame PD ray, symmetrical return, and high time frame targets. So with market maker model, you want to have symmetry. Always, always, always. One of the best ways to know when market maker model is failing is when the symmetry gets broken. In the market maker buy model on the right side of the curve, you want to see the left side sell part to provide support for the buy curve. So whenever you break a level of redistribution from the left side, it will act as support for the accumulation on the buy side of the curve, inside buy program. Okay, here's general idea what is market maker model. Here's what do I mean by symmetry. First stage supports first stage right here. Second stage supports first stage support second stage right here, first stage second stage right here, support first stage right here. Every single liquidity level at this sell side of the curve will be support level or resistance level on this buy side of the curve, depends on the direction. All right. Okay. In order to anticipate smart money reversal and transition from, let's say, from buy program to sell program, you must have 3 points. You must consider 3 points every single time. You must consider high time frame PD ray. Always, always, always. Everything starts with higher time frame PD ray. After this, we want to find change in the state of delivery. And last point is going to be market structure shift. Once again, exactly in this order that I highlighted here. High time frame PD ray, change in the state of delivery, market structure shift. For example, right here we got what? We got high time frame level, we got change in the state of delivery, market structure shift, first stage right here, second stage right here, move higher to our higher time frame level, bearish level, then reversal. Every single level supports this sell side of the curve. We got support right here, support right here, support right here, support right here. Okay. A relation of higher time frame pedigree and market maker model. Okay, higher time frame level can be any pedigree that was explained by ICT. It can be fair value gap. It can be any type of blocks such as propulsion block, breaker block, order block, mitigation block, rejection block. It can be volume imbalance. It can be old liquidity levels such as old high, old low. But what is the relation between higher time frame levels and market maker model? Okay, when we are on higher time frame chart, such as let's say 5-minute chart also can be higher time frame chart. You must keep this in mind. And let's say we are inside 4-hour pedigree. We are now inside 4-hour chart. What do I mean by this? Let's say we entered bearish 4-hour order block, bearish 4-hour fair value gap. At this point, in order to find best entries for your market maker model, in order to find the best structure with best trade ideas, you would like to use 5-minute chart. Of course, you will see this on 15-minute chart. Of course, you will see this on 1-hour chart, on 1-minute chart, this smart money reversal. But for 4-hour pedigree can be once again fair value gap, breaker block, order block, mitigation block, and any other pedigree that you know. You would like to use 5-minute chart for your structure, where you want to find, once again, where you want to find what? You want to find change in the state of delivery and market structure shift. This means once we entered higher time frame level, in this case we are talking about 4-hour pedigree, it can be 4-hour fair value gap, for example. You want to switch on 5-minute chart to find change in the state of delivery and market structure shift. Same idea applies, let's say, for weekly pedigree. We are inside weekly fair value gap, weekly order block, weekly volume imbalance. You are going to use 1-hour chart to find the best entry and best structure to trade market maker model. Once again, for weekly pedigree, of course, you will see this market maker model on daily chart, on 4-hour chart, on 1-hour chart, on 1-minute chart. On every single time frame, you will see this market maker model. But best entry and best structure will be on 1-hour chart. Same idea applies for monthly chart, 4-hour structure, weekly 1-hour structure, daily 15-minute structure, 4-hour chart. 5-minute structure, 1-hour or 15-minute chart is going to be 1-minute structure, and for 5-minute chart, you're going to use 30-second structure. Of course, if you would like to use 1-minute pedigree as your higher time frame chart, most likely you will want to find 15-second structure or even 5-second structure. It's totally up to you what time frame you want to use. Okay. Once again, once we reach any higher time frame level mentioned previously, it can be breaker block, it can be order block, it can be mitigation block, fair value gap, and any other PDRs. You want to look for lower time frame market maker model. This means that if we reach, for example, for our PDRA, I want to focus on 5-minute structure to play market maker model. Okay, the picture below shows you how high time frame move appears on low time frame. Okay, let's see here. We got high time frame chart right here. Let's say it's going to be daily chart. We got daily chart right here, and this move down to the fair value gap on daily chart, and this reaction from here is going to look like this on what time frame? It is going to look like this on 15-minute chart. This means on 15-minute chart you will see this move down and up like this. And on 15-minute chart, you will want to find the structure, which is what? Change in the state of delivery and market structure shift. Here's example, ES example, if not mistaken. We got daily fair value gap. We want to switch on 15-minute chart to find what? Change in the state of delivery, market structure shift, and then you want to find first stage, second stage of accumulation and reaccumulation. Okay. Now let's talk about change in the state of delivery, because this is very key structure point for us to understand if you entered smart money reversal or not, if you entered this transition from one program to another program or not. Okay, first, you should understand that change in the state of delivery creates what? It creates a real order block. Once again, order block is a change in the state of delivery. Change in the state of delivery is order block. Second, change in the state of delivery means real change. That's why we call this change in the state of delivery, because it changes something. It changes what? It changes order flow. This means this order block must change, offers a change in order flow to confirm what? Smart money reversal, right? Okay, key concept of smart money reversal that you know from ICT 2022 mentorship. It is going to be liquidity sweeps. It can be higher from PD rate. It can be changed, not can be changed. It must be first higher from level. Second must be change in the state of delivery or order block. Order block, once again, is a change in the state of delivery. Change in the state of delivery is an order block. Third point right here is market structure shift. And fourth, not necessary, but we must say about this, fair value gap, which most of the time offers what? Low risk buy, low risk sell. Okay, in order for us to get a real change in the state of delivery, we need to use the very first candle. The very first candle that brought us to the higher time frame level. This candle will be our real change in the state of delivery or real order block, and this answers questions that I got every single day about how many candles do I need to use for order block. What do I mean by this? Okay, let's take an example. We got this example, perfect example, so I'm going to read this text and then I am going to explain how it's going to look like on this picture. Okay, just imagine that we just run into the higher time frame fair value gap, higher time frame imbalance. And this candle number 1 right here was the very first candle, right, that reached this fair value gap. Not this one, this one. See? And after candle 2, right here, we saw a drop and closure below the candle that brought us to the higher frame level, which is fair value gap at this point. After candle number 2, we saw candle number 3 that offered sell-off and closure below the wick of the first candle that brought us where? To the higher frame level. Once again, below the wick. In order to confirm a real order block, we want to see closure below the wick. No matter how big this wick, you must consider closure below or above the wick as your real order block. Well, what we'll have now? Now we have a bearish engulfing candle right here, number 3. And we will have is a real change in the state of delivery, because now this candle that makes move up right here to this fair value gap, and with this candle number 3 that closed below this candle number 1, now we got bearish order block. Okay, how many candles at this point I would like to use for this order block? I'm going to use candle number 1 and I'm going to include candle number 2. At this point, I'm going to use 2 candles. Okay, this candle number 1 right here was the very first candle that brought us to this higher frame fair value gap or any higher frame levels. Once again, it can be fair value gap, order block, breaker block, any other PDRs that you know. And candle number 2 was just continuation of move of this first candle. Candle number 3 offered drop and closure below candle number 1. Once again, that brought us to this fair value gap. This means that on lower time frame, this candle number 2 is going to be market structure shift. Once again, Since candle number 2 was continuation of candle number 1 and candle number 3 was reversal on lower time frame, you will see this candle number 2 as market structure shift. But if candle number 2 never ever was continuation of candle number 1, it was part of sell-off, part of reversal, candle number 2, wick of this candle wick down, low of this candle is going to be market structure shift on the lower time frame, and it's going to be breaker block on lower time frame as well. But once again, if we can see continuation of first candle right here with candle number 2, we expect to see what? We expect to see low of candle number 2 is going to be market structure shift on lower time frame, and low of candle number 1 is going to be breaker block on lower time frame. For example, we got gold chart right here. So what I can see here, we got 15-minute chart, price moved down, retraced down to the 15-minute bullish fair value gap. Candle number 1 right here was candle first that touched this change in the state of delay. Why I decided to use this candle and not this candle? Because we got the closure below this low. Right here. We got mitigation of this order block, so we got new structure right here. That's why I decided to use this candle at this point. And this candle number 2 wasn't part of continuation, it was part of reversal. This means on lower time frame, this week high of this candle is going to be lower time frame breaker block and market structure shift. Okay, since we got 15-minute PD ray, I would like to use 1-minute structure. Let's take a look. Here's 15-minute order block right here. Here's 15-minute fair value gap. This orange line is right here. As we can see, it was part of market structure shift and breaker block. This is what I mean by lower time frame breaker block and market structure shift when I consider candle number 1 or candle number 2. Depends on what. If it was sweep, once again, it must be sweep or failure to close above the high. If it's going to be bearish candle, we got opening, closure right here. We can call this as sweep, liquidity sweep. Now let's talk about first stage of accumulation and distribution. Okay, first stage of accumulation or a distribution is the very first retracement after market structure shift. In order to confirm this, we would like to find when the first stage is likely to form by understanding intermediate term, high and low. Okay, you must keep in mind from ICT 2022 mentorship, I guess it was video number 19, episode number 19, if not mistaken, he explains that intermediate term high is a high that has short-term high on the left side of this intermediate term high and on the right side of this intermediate term high. Once again, it must have short-term high on the left side and must have short-term high on the right side. An intermediate term low is the low that has a short-term low on the left side of this intermediate term low and on the right side of this intermediate term low. Like this. We got intermediate term low, short-term low on the left side and on the right side. After we saw market structure shift, which was our low risk buy right here. So we got market structure shift, retracement to the fair value gap. As I said before, fair value gap can be part of low risk buy, a low risk sell. Our focus right now will be for to confirm first stage of accumulation will be, or distribution, in this case we got picture for buy program. Our confirmation for first stage of accumulation is going to be the very first run on sell stops, turtle soup entry at this, and we are going to mark this as our first stage of accumulation. What do I mean by this? Now, once it starts to break up, continue moving higher, there will be more short-term lows being formed right here, and this whole range up. And we are waiting for short-term low after the low risk buy right here, get traded. What do I mean by this? I would like to see move down below this short-term low. This short-term low must be right after low risk buy, low risk sell. So once again, I am waiting for the short-term low after the low risk buy to get traded, and then we form that intermediate term low. We expect price will not go lower, will not break this intermediate term low anymore. We expect to see this as protected low. This means once we got this move down below short-term low and then a reversal, a reaction up from this short-term low, I want to consider here as turtle soup entry. And once we got reaction with next retracement down and failure to run below this intermediate term low, we got short-term low on the right side, and this intermediate term low right now is what is protected low. Once we saw that the run on sell stops and confirm first stage of accumulation, we wait to enter second stage of reaccumulation. Okay, let's take a look. We got short-term right here, short-term low. It was get traded right here. It get traded right here. We got intermediate term low, move up. Another retracement, small retracement. Once again, it cannot be huge move down. It can be just small retracement. So now we got short-term low, intermediate term low, short-term low. This intermediate term low right here now is protected low. We got first stage of accumulation. After this, I would like to see formation of second stage of reaccumulation. The first confirmation for us will be the next retracement down after it formed intermediate term low. This is where we entered the first stage of accumulation. So we entered first stage of accumulation right here. This first retracement down after formation of this intermediate term low was right here. With this retracement, the price must hold above intermediate term low. Remember, once again, you need to have short-term low on the right side of intermediate term low, and you must have intermediate short-term low on the left side of intermediate term low and on the right side, right here. So we got on the left side and on the right side. This means with that retracement, it must form short-term low right here, and this short-term low will be key point for us to enter second stage of reaccumulation. Okay, what can we see? We got low risk buy right here. We got the very first retracement down after this low risk buy we formed. Short-term low, move up, continuation of this move up, this entire buy program confirmed by what? We got higher from level, we got change in the state of delivery, we got market structure shift. We got continuation, then price reversed, move down right here below the short-term low and created intermediate term low. Then continuation higher again and next retracement down with failure to break below this intermediate term low. Now this means we got another short-term low on the right side of intermediate term low. This is where we are about to enter second stage of reaccumulation. As I showed right here, we got short-term low, intermediate term low, short-term low. Okay, now let's talk about silver bullet, because it can be kind of part of first stage, but it's in the middle between first stage of accumulation and second stage of reaccumulation. Okay, let's take a look at this picture. We got additional consolidation right here, then move down. So basically the sell side of the curve, where we reach discount higher frame array, any higher frame level. This is where we got smart money reversal confirmed by change in the state of delivery and market structure shift. Once again, I already said that, but I'm going to repeat again. After we saw break of structure, market structure shift, and this is where low risk buy was formed right here. inside this buy program. As we already know, turtle soup is a part of first stage of accumulation. We expect to see short-term low, intermediate-term low. Another entry on this buy side of the curve, once again, first entry is going to be low risk buy. Another entry can be first stage of accumulation. So another entry for this buy program will be very first run on sell stops. Right here, turtle soup entry, and this is our first stage of accumulation, as I said before. We are not looking for this when we want to trade silver bullet. We are interested in second stage of accumulation, this market maker buy model. But as I said, I would say silver bullet usually between first stage and second stage. What does it mean? Look at this picture below. Once it starts to continue moving higher, as I said already before when I explained short-term low right here. So we can see it get traded this short-term low. We got first stage of accumulation right here, then move up, another retracement down with failure to take this intermediate term low. Means it formed short-term low on the right side, right? And we expect the price is going to hold this intermediate term low as protected low right here. Okay, that's nice. But here, how you want to trade silver bullet. Let me remind you. Silver bullet time is between 3 and 4 a.m. New York time, 3 a.m. to 4 a.m. I'm going to talk about New York time always, so I don't need to repeat this all the time. For a.m. session, this is between 10 a.m. and 11 a.m. For p.m. session, this is between 2 p.m. and 3 p.m. So, in anticipation of that intermediate term low formation right here, we can see second stage of accumulation forms after we run intermediate term low. After we form intermediate term low, we got short-term low, intermediate term low, short-term low right here. And as I said before, once it forms this short-term low on the right side, we are about to enter second stage of the accumulation. Right here. This means that after the very first fair value gap, after it formed short-term low on the right side of intermediate term low, will be our silver bullet. Once again, once we got first stage of accumulation, we got short-term lows and it get traded right here. It formed intermediate term low with next retracement down. After it formed intermediate term low, it failed to take and failed to break below intermediate term low. Now we got what? We got protected low. So we got short-term low on the right side, and the very next fair value gap after this short-term low is going to be silver bullet fair value gap. Once again, between 3 and 4 a.m., 10 and 11 a.m., 2 and 3 p.m. Here's an example on NQ. We got 15-minute fair value gap. We got 1-minute change in the state of delivery. We got market structure shift. Perfect. We got short-term low, continuation higher than break below the short-term low, intermediate term low, continuation, retracement down, failure to break below this intermediate term low even by 1 tick. It's okay. Formation of short-term low on the right side. This means that the very next fair value gap after this short-term low is going to be silver bullet. It was, if not mistaken, it was AM session. So right here, as we can see, it offered what? Run to this fair value gap. Formation of silver bullet. Entry. Continuation higher. I'm going to explain how you need to pick your targets a little bit later today, but here was the target. Here's example on Bitcoin. We got 15-minute order block. We got 1-minute change in the state of delivery. Once again, why I used 2 candles? Because this candles was the very first candle that brought us to this 15-minute change in the state of delivery. 2 candles is on 1-minute order block right here. Market structure shift. Move down. Formation of intermediate term high. Once again, I can consider short-term high right here. Totally fine. I can consider right here. Totally fine to use this. Move down. Retracement, formation of short-term high right here. With our next fair value gap after short-term high? It was right here. It was PM session, if not mistaken. Entry, target. Entry for silver bullet. Stop loss is going to be above short-term high right here as well. Your stop loss for this silver bullet lesson is going to be below short-term low. Right here above short-term high. Okay, let's continue talking about stages. Here is the second stage of reaccumulation or redistribution. As we can see here, we got another retracement down after we entered the first stage, as I said million times already. With this retracement, short-term low was formed, and this means we are about to enter second stage of reaccumulation. From our previous lesson, I guess it was explained in my pre-market video, but if not, I'm going to talk about time distortion in my next video. From my lesson, I guess it was posted on Twitter as well. We know that time distortion will be always part of second stage of reaccumulation. Okay, time distortion is consolidation. Consolidation is a time distortion. Completely two the same things right here. Two different names. After we saw formation of short-term low, on the right side of this intermediate term low right here, intermediate term low, short-term low, we need to find the very first fair value gap after the short-term low. Once again, if you trade silver bullet, you want to find this on 5-minute chart, on 3-minute chart, on 30-second chart, on 1-minute chart. But when you trade high time frame level, it's going to be this fair value gap is going to be also high probability fair value gap, but not silver bullet fair value gap. This fair value gap after the short-term low on the right side of this intermediate term low will be a key level for us where we want to see distortion set up before finishing buy program. Let's talk about this right here. We got, once again, short-term low, intermediate term low, short-term low with the very next fair value gap. Time distortion, second stage of reaccumulation, move down, where to this fair value gap, and then reversal. Reversal where to finish our market maker buy model. Here's an example. We got short-term low, intermediate term low, short-term low, very next fair value gap right here, time distortion, move down with this time distortion can be only like 3-5 candles. It's okay. It doesn't have to look like this. I mean, like consolidation. No, it can be just a couple of candles. Totally fine. Move down, formation of fair value gap. Right here, we got move to this fair value gap. Continuation to higher time frame level. It was Sunday open from May 29. This fair value gap after short-term low will be a level where price may trap, but not necessary to see this. But most of the time you will see the picture like this. This fair value gap will be a point of reversal for our time distortion setup. Time distortion, once again, is a consolidation where most traders usually get trapped. What do I mean by this? Most traders going to short right here because they're trying to find market structure shift. It can be like random buy side liquidity, something similar to 2022 model. Then they are going to stop out right here. Market makers typically accumulate longs or shorts to finish market maker model by using this consolidation as part of second stage of reaccumulation or redistribution. Remember, we want to play the second stage of reaccumulation only after we run distortion, consolidation low or high, and enter using inversion fair value gap idea. Okay, what do I mean by this? We got time distortion. In order to trade second stage, you would like to see run below distortion low always. You don't want to enter in the middle of nowhere, never. You want to wait for run distortion low right here, and with this leg down you want to see formation of bearish fair value gap right here. And after this, you would like to see immediate invalidation, formation of inversion fair value gap, and inversion fair value gap will be your entry for second stage of reaccumulation or redistribution. Okay, fair value gap right here after short-term low. Time distortion, move down, break below distortion low, formation of inversion bearish fair value gap first at this leg down that broke distortion low, then immediate invalidation, inversion fair value gap, stop loss. And for second stage of reaccumulation is going to be right here. Not lower, not short-term low anymore, right here. And then continuation higher. So you can enter this setup. You don't need to wait for a retest of this inversion fair value gap. You can enter once we got closure above this bearish fair value gap. Candle closure, next candle is going to be your entry. Stop loss once again is going to be right here. Right here. Target is going to be higher from level. In that case, it was Sunday open. Okay, how do we need to choose what level you want to target? I personally use 4 ways to find my target. First is going to be opposite array. I'm going to explain what does it mean. Standard deviation, equilibrium of quarter to daily cycle, measuring gap. Okay, what does opposite array mean? This means that I can target same PDA where smart money reversal happened. For example, if CL, it can be any other instrument, just wanted to use different examples from different instruments. If CL reversed from 1 hour bullish order block, right here, we got reversal. I would say exactly from mean threshold of this order block. I want to target opposite bearish 1 hour order block, which is right here. So this move up is going to be my buy program, buy side of the curve. Also, we got example of this. Let me find for you. Here we go on Bitcoin. We got 15-minute order block right here, bearish, and we want to target bullish order block. Opposite arrays. Okay, standard deviation, the most interesting part. Once again, maybe some people use this in a different way. This is my approach. It can be different from yours or from ICT, from any other mentors. So I don't care. Here's my approach. When I use standard deviation projections, I must understand what instrument do I trade. If I trade ES, it's going to be completely different way how I'm going to use this projections, for example, for NQ, CL, DXY, Forex market, crypto market. For ES, I use completely different way, but only for ES. For any other instruments, you are going to use different levels, but for ES. Okay, once again, I want to see smart money reversal confirmed by higher frame PD array, change in the state of delivery, and market structure shift. Only after this I can start drawing manipulation leg projection. I will use the very last leg before reversal confirmed by, once again, higher from level, change in the state of delivery, market structure shift. And this leg, this last leg before reversal is going to be my manipulation leg. Right here. The very last leg that brought us to higher frame level, then reversed, offered change in the state of delivery and market structure shift. This leg is going to be my manipulation leg. After I draw manipulation leg, I highlighted this on my chart. I'm going to use FIB retracement tool with 1 standard deviation, 1.5 standard deviation, 2.5 standard deviation, and 4 standard deviation levels. The range between 1 and 1.5 standard deviation is going to be my retracement range. I will be interested in retracement of the breaker block, and it must be breaker block only. Not order block, not fair value gap, only breaker block. This means from this, once I found my manipulation leg, I want to use these levels right here. And this range between 1.5 and 1 standard deviation is going to be my retracement range. Once again, for ES, retracement where? To breaker block. Always, always, always. After price reach this breaker block, on the same time frame where we expect to see market maker model. What do you mean by this? If you used daily chart as your high time frame chart, you're going to find 15-minute structure, 15-minute manipulation leg, 15-minute breaker block, everything inside 15-minute chart. I expect to see continuation of the move to the 2 standard deviation, and this level will be my partial level always. No matter if you anticipate to see continuation lower, I don't care. My 2 standard deviation level is going to be my partial. Right here, I'm going to take partial. We got reaction from this breaker block. I'm going to take partial at 2 standard deviation. You must take partial as well. At the range between 2 and 2.5 standard deviation, I will expect to see another retracement to the fair value gap that was formed around 1 and 1.5 standard deviation. And once we reach this level, this is where I would like to move my stop loss. I'm going to show you a real example soon, and my target is going to be 4 standard deviation. Keep in mind, we took partial 2 standard deviation, then we got, even like it, if it went a little bit higher, from this range between 2.5 and 2, I would like to see retracement down, last retracement, where to the fair value gap that was formed ideally inside the range between 1 and 1.5. This fair value is going to be my entry, and my stop loss is going to be nearest sell side liquidity. Nearest. It's not right here. It can be a small retracement right here, but nearest sell side liquidity. And I'm going to target 4 standard deviation. Let's take an example. We got example, example. It was 1 minute chart. Don't remember, it was March or April. I don't remember what day it was, but it was in my live stream. So this example was from my live stream. We got leg down. We reach some sort of 15 or 1 hour, 15 minute or 1 hour PDRA. I didn't highlight it. So we got reversal, we got order block, we got market structure shift, we got change in the state of delivery. I drew my manipulation leg right here. So here's my levels. Once again, 1, 1.5, 2, 2.5, 4. Between the range 1.5 and 1 standard deviation, I would like to see a retracement. Retracement where? To breaker block. It's going to be my first entry. We stop below the low. My target still will be 4 standard deviation. Once I saw price respected this breaker block, I want to take partial at 2 standard deviation. Once again, always I want to take partial at 2 standard deviation. Then, between the range 2 and 2.5 standard deviation, I would like to see another retracement. Retracement where? To the fair value gap that ideally was formed inside 1 and 1.5 standard deviation range. We got fair value gap. I'm going to enter here, and I would like to find near sell side liquidity right here. My stop loss right here, target is going to be here. If you enter it right here, you can add more right here and move your stop in profit right here. For NQ, DXY, gold, or any other instruments, I use it in a bit different way. Same idea with manipulation, like confirmed by the higher frame level, change in the state of delivery, market structure shift. But my interest in standard deviation level will start on only once price reaches the range between 2 and 2.5 standard deviation. This range usually is a part of second stage of reaccumulation or a redistribution. This means that we will expect to see time distortion at this range between 2 and 2.5 standard deviation and final setup to finish market maker model. Between 2 and 2.5 standard deviation, I want to see consolidation that finally will offer run below or above consolidation low and high that was explained before. With this run, I will wait for formation inversion fair value gap to enter my trade as part of second stage of reaccumulation. I mentioned that before, right here on this picture. Ideally, when a trend distortion high or low, I want to see run to the fair value gap that was formed after right after short-term low on the right, or short-term high on the right side of intermediate-term low or intermediate-term high. Usually this fair value gap forms inside the range between 1 and 1.5 standard deviation. Here's example. Here's was my execution. Why I decided to show this on 15-second chart, just to show you that it works everywhere, on every single time frame. As we can see here, time distortion. We got time distortion right here between 2 and 2.5 standard deviation. Once again, ideally, I would like to see formation of time distortion, second stage of reaccumulation, redistribution inside the range between 2 and 2.5 standard deviations levels. Additionally, after it broke the distortion low, right here, it runs a fair value gap that was formed after short-term low. Short-term low right here, intermediate-term low, short-term low. Fair value gap right here, then highlighted. Fair value gap right here. We can see once it broke distortion low, consolidation low, it entered this fair value gap. This fair value gap was inside 1 and 1.5 standard deviations. Then we immediately reversed and validated this bearish fair value gap and formed what? Inversion fair value gap. Inversion fair value gap is going to be my entry, and my stop loss is going to be low right here. Target for standard deviation. Simple as that. Okay, third way to to find the target. Equilibrium of quarter 2 daily cycle. Okay, I use indicator inside TradingView. It's called like quarterly cycles right here. So you can find this, I guess it's available for free for everyone. To find equilibrium of quarter 2 daily cycle, I open 1 hour chart and look for quarter 2 red area. Red area, this red area, see? It was on 1 hour chart. So I look for 1 hour area, this pink area. That was an key moment right here. It must be part of consolidation, not expansion. We got consolidation right here. It was part of expansion right here. It was part, I would say it was consolidation. So once we reach this level, I want to target this level, most likely. Perfect. So it was part of expansion, but I am interested only when it was part of consolidation, overnight consolidation. So you are interested in time between midnight and 6 a.m. You would like to use this equilibrium of quarter 2 once we got this between midnight and 6 a.m. consolidation. If it was part of expansion, no interest. In order to consider equilibrium as high probability target, quarter 3 must start with manipulation and then offer expansion. If quarter 3 wasn't manipulation, I am not interested in this level, so I'm not going to target. Quarter 3 must be manipulation first, means we got overnight consolidation, we got quarter 3 New York IM session as manipulation, then expansion down. So I'm going to target once again this level once I saw it was manipulation and quarter 2 was part of consolidation. Here's example on NQ. Consolidation. We got what? We got manipulation, then reversal. I want to target my market maker model, and here is going to be my target. For market maker model, my target is going to be equilibrium of quarter 2 daily cycle. Same idea on DXY. We got consolidation, small manipulation. I'm going to target, use equilibrium of quarter 2 daily cycle as end of my market maker buy model. Want to find real example. So we got right here. See, it was overnight consolidation with manipulation right here, then expansion. Power of 3 idea. Target equilibrium of quarter 2 daily cycle. And last one for today, measuring gap. A measuring gap is the fair value gap that forms at the middle, at the 50% of implied range. This fair value gap typically appears right after short-term low or short-term high on the right side of intermediate-term low. I usually consider projection of this measuring gap as my target for when this fair value gap is a big range fair value gap. This fair value gap can be what? Silver bullet fair value gap, right? Why? Because it's the very first fair value gap after short-term low, short-term high on the right side of intermediate-term low, intermediate-term high. It also can be part of time distortion setup. It can be part of second stage of the accumulation, the distribution idea. So this fair value gap, very first fair value gap, when we got big range fair value gap, we are going to use projection as our target. So we want to target projection level based on measuring gap. Once again, the measuring gap is the fair value gap, which is approximately in 50% of implied range and part of second stage of the accumulation or redistribution. To get measuring move, I use the low or high where smart money reversal happened, and I use the top or bottom of the measuring gap of this big range fair value gap. The 100% move from this measurement is going to be my target for market maker model. Let me show you. This example on some forex pair. I don't remember what exact instrument right here, but here's an example. We got 4-hour order block. Perfect. We got 5-minute change in the state of delivery. We got market structure shift, intermediate term high, short-term high on the right side. The very next, in the first fair value gap after short-term high, is going to be our part of second stage of the distribution. It can be silver bullet. As you can see, it's not time for silver bullet, but we got big range fair value gap. So we can expect what? We can expect with time distortion, we run distortion high, and we enter this fair value gap. And I want to target 100% measuring move right here. So this area is exactly this area right here. 100% move is right here, from high to low of this fair value gap. Here we go. Okay, this was the lesson how I personally use market maker model. This is how I understand this. I didn't invent anything here. Everything is available on ICT YouTube channel. So I hope you found this helpful. It can answer some of your questions if you had this before and no one answered this before. So if you like this video, don't forget to hit the like button and subscribe to this channel. In case you got some questions, you can leave a comment under this video or send me a direct message on Instagram or Twitter. So guys, thank you for watching and I will see you in the next video. Bye bye.